G'day trader, Stacey Burke from Stacey Burke Trading. Just following up on some questions and emails regarding the templates. A lot of traders have heard me kept mentioning day 1, day 2, day 3, the templates. So we'll just do a short video to review the big picture and scaling that down to trade setups and understanding when I'm looking for session scalps or scalable trade setups and how they can present and why it's important to understand the templates. So we have, just going back to, the daily charts, I've talked about this in previous videos. The beginning of each new month, we have the potential for a market to do one of three things: either be in a trading range, in a trend, or in a reversal situation. We've gone over this. Markets only do three things: they break out, they pull back, and they trend. They break out, they pull back, and they fail and reverse, or they trade back and forth inside of a high and low in a trading range. It doesn't matter what we look at. We can look at the Aussie dollar, but each new month we have the potential for maybe month 1, month 2, month 3, peak formation, and a move all the way back down. So just understanding that timing of the new month can potentially be the beginning of a new cycle, a new trend, a reversal, or trading range type of opportunity. Doesn't matter if we look at gold, we can look at indexes, S&P, oil. Again, this breaks down into 4 weeks. We can look at the New Zealand dollar. So approximately 22 days, trading days in each month. And that breaks down into 4 weeks, 4-week cycles. We have week 1, week 2, week 3, week 4. So we can be in a larger macro cycle. Month puts in a low, the next month begins the march up, month 1, month 2, the new month begins month 3. There's a 1, 2, 3 for a move all the way back down. I suppose the emphasis of this is understanding that the same patterns show up on our smaller time frames and in our weekly cycles. Day 1, day 2, day 3. We've talked about this being also we can get 3-hour session pump and dumps, or trend trades, or 3 levels of rise over Asia, London, New York, or London, New York, Asia, or New York, Asia, and London. So if we just look at any pair, if you're looking, and again, we're going to scale this down to setups, but when the new month begins, we have our first week puts in a low and a high. In just looking at the pound, this is just an example of a new month beginning. We have a high and a low. The new week begins. We have day 1, day 2, day 3 up high. First red day, the market fails to follow through, but the second day on the Friday, we get the large range breakout. And again, just understanding that getting what a first red day is, how that relates. It's not just a down day. It's if a market breaks and fails after 3 days of rise or 3 days of fall, if it's a first green day, is anybody trapped? And coming back again to major round numbers, double zeros and 50s. This all is deconstructible down to your best trade setup. So we can see week 1, week 2 breaks out at the end of the week. Week 3 comes down, puts in a peak formation low after day 1, day 2. Day 3 is a reversal inside, and we start the march back up. Day 1, day 2, day 3, peak formation on the upside, closing Friday as an inside day. And then we have the entire week last week inside of our previous Thursday, and essentially contained in a 200 pip box, roughly speaking, on the outside boundaries between 50s on both sides. We have a 100 pip box, 50 pips outside of the range on either side. And again, I talked about this yesterday, just focusing on major round numbers and then also understanding what your best trade setups are. So although we can zoom in and just look at an example of a market that moves 100 pips between Monday and Tuesday, and essentially all this choppy price action to me is not ideal, because although it's moved 100 pips, where would a trader have put size on this unless they just took a position, put a stop loss in with massive size, and held on to it through all this back and forth until finally on the third level, level 1, level 2, level 3. We get a blow off in the direction of that move before they're able to finally capture that profit, as opposed to taking a 50 pip blow off, which you're in at the open of London, and bang, you're out in 30 minutes with zero stress. So just coming back to, I asked that question yesterday, do you know what your best trade setups are? And I talked about, I'm biased to the short side. I have long setups, I have trend setups, I have short setups. But just looking at this chart, this is a short trade setup. There's an entry, a stop, and a take profit. But coming backwards as to why this would have come up in your daily screen or your daily process, when we just add levels and timing blocks, this is a US session. We're above 50. We have peak formations. The high's already locked in prior to entering this trade. They've done their stop hunt into the triple top. Entries at 50. The take profit was down 100 pips away. When we back this up and we look at the larger template, okay, we have Monday, Tuesday, peak formation, day 1, day 2, day 3's first red day. Day 3 was first red day on Wednesday. First red day. The market then sold off in Asia, pulled back, sold back down again in London, began a march up, and you'll notice again counting 1, 2, 3 up. It's 45 minutes, but this is just prior to the US window. And then when we go to our smaller time frame, we have our best trade setup. So again, I'm just emphasizing understanding what it is exactly that you're looking for, and then being able to identify when your larger opportunities present and why it has presented, and expecting that you're going to get that opportunity, whether it's on the Japanese yen. The instrument itself is irrelevant. So same type of setup, just a different subtle variation. Again, an entry, a stop, and a take profit. When we add in our levels, session timings, we know that this is the first bar of the London session on the S&P. So again, instruments are relevant. It's the opportunity and the pattern and the setup. Understanding the different profit potential based on the volatility of the instrument. And again, there's only three things: an entry, a stop, and a take profit. But this is a timing window. This is a London Open. The Japanese yen was the US session open. A pattern's a pattern. So again, I'm just using short examples from this week, but you could have your trend trade examples. This is just, again, another short trade example on oil. So again, add our levels in. We have timing, New York Open. We have our pin hammer locking in the high. We have our consolidation underneath the peak formation. We have our entry, our stop, and our take profit. Take profit being major round numbers, 105. That's a 150 pip drop plus. So again, when you're able to spot the setups, you're still going to execute the same. You have your stop loss in place. And then the process is about identifying which candidates are going to offer you the best trade setup. So it's the setups, as opposed to me coming to the screen and looking for, okay, I only trade gold, so what am I thinking today? Should I go long? Should I go short? And not to say that, again, I've always said whatever works for you, whatever you resonate best with, but I'm talking about when you have your best setups and you know what you're looking for, then you know that you could come, possibly you have your best trade setups are longs. I talked about with gold, double zeros and 50s. Now, if we just step back and look at the bigger picture, again, just coming back to the very beginning of the month, we have week 1. Week 1 puts in a peak formation low, peak formation high. So again, we can see when we're inside, and again, we may be just trading session scalps, but as the week evolves, we have day 1, day 2, day 3, a blow off on after first red day, a blow off to the low of the month, the vertical move that we all went through and talked about. But gold has 100 pip boxes and 50 pip stop hunts outside of the range. So there may be short trade opportunities once it goes 25 to 50 pips outside of the double zeros. We're inside at the low of the week, the low of the day, at the end of the London 3-hour window. And this is a 15-minute chart. On oil, S&P, NASDAQ, I have 250 pip boxes, but when I scale down for the tighter trade setup, I'm looking at my normal 100 pip boxes. I talked about the same principles apply. We have week 1 on oil. And if you just look at the 1,000 pip box increments, we go 250 pips, 25% outside of the range. The new week takes out the high on the Friday, breaks down. New week starts, we go down 3 levels. 3 levels is 750 pips. They put in peak formation lows possibly day 1, day 2, day 3. They trap volume underneath the 500. Okay, the short trade I took was on the Wednesday, back to the 500 level. So again, just understanding where you're at in the template. There was short trades with the trend Wednesday morning. Peak formation lows, trapping volume. Now, are they going back up to the high of last week? I have no idea. We're in the last week of the month. This market could roll over and test the low of the month, or it could break back inside and be working its way back up. But essentially, point being is when you can identify your best trade setups, instrument is irrelevant. The time frame is irrelevant. We can look at different pairs. We can look at the same type of situation, 3 levels of rise, consolidation, and the dump. Again, these are short trading examples. When we put this up on the bigger picture, this is the New Zealand dollar, Friday peak formation low, day 1, level 2, level 3, above 50. Okay, we don't know what's happening until the pattern starts to complete. We have a short trade opportunity in Asia on day 3 in the Asian session for a 75 pip move down. So same type of setups, different time frames, different instruments. Again, week 3, day 1, day 2, day 3, 3 levels of rise. Is every pair going to be different? No, but if you study these templates and you go back and look at where you're at in the larger template from the beginning of the month, again, similar to the pound, the cross pairs will resonate similar, meaning the US dollar pairs will probably trade to some degree with some similarity. The other Euro, Pound, Aussie, New Zealand, Gold, they trade in a similar pattern as well. So again, but the same weekly templates, day 1, day 2, day 3, it might be similar to what we saw in the yen. Day 1, day 2, day 3, first red day, and it breaks down. 3 sessions, short trades. They're not all going to be the same. First red day, we want to see volume caught. Same thing with first green day. And the market will throw curveballs at you. We can look at the Fed day on gold the previous week, first green day. They dropped at 3 levels for the vertical move in the U.S. session. So again, and that starts a new count. Day 1, day 2, day 3 for the sell trade in New York on the Friday. These are all the types of opportunities that if you study and understand the larger time frame templates and then break that down into your weekly templates and then into your sessions, then you can have a process for looking for your best trade setups, whether they're shorts, they're longs, or they're just scalps. For a session scalp, and again, understanding the volatility of the instrument that you're trading and its potential. So, for example, you might be in a 25 pip trade. Well, don't expect that you're going to get 150 pips on the New Zealand dollar when it's a scalp to the low of the day or to the low of the session. So hopefully that helps. Look at the bigger time frames, study your templates, day 1, day 2, day 3, first red day, first green day, trend setups. You can look at trend setups. If you're not sure what a trend setup looks like, the Japanese yen's an excellent example. First day of the month, you can draw your rectangle. There's different variations of this, but this essentially forms your rectangle 4 days into the month for the continuation breakout of a trend trade. But eventually that trend trade gives a first red day. We had a first red day the previous week. Again, peak formation low, Bank of Japan brings it up another level. Whenever you see these huge levels of rise, start to think pump and dump. First red day again, we have trap volume up high. And this market could still go higher, but there's still some huge opportunities for trend trades. Day 1, day 2, rectangle, peak formation high, peak formation low, pull it back inside, trend the market. Day 2, first red day, day 3, short trades, day 4, consolidation, peak formation low. We'll see what happens at the beginning of the week. Keep it simple, traders. Study your best trade setups. Work backwards. Know how they set up. Study the larger picture, the bigger templates, and then go into the market prepared, being able to identify the best candidates for your best trade setups. Enjoy your Sunday, and may the markets go with you.